Welcome, everyone. I'm Mary Brown Sands, Chief Marketing and Communications Officer at the Small Business Investor Alliance, the leading association for lower middle market private equity funds and investors. The SBIA is an alliance for professional networking, business opportunities, innovation, regulatory expertise, and market data, and works on behalf of its members as an advocate for policies that promote robust domestic investment for growing small businesses. We are pleased to continue our fall Lunch and Learn webinar series with today's session, What Happens Now? Key LIBOR Considerations After Year End. There are just a few housekeeping items to cover first. In your GoToWebinar menu bar, please find the questions feature. If you have questions during today's webinar, this is where to submit them. Also, please use this feature to let us know if you are having any technical issues, and today's technical director, Ainsley Stoy, will reply with suggestions. The situation around LIBOR is fluid, and the goal is for this session to be interactive, so please ask your questions freely as they arise. Also, understand that while the financial industry has been mobilizing and making preparations ahead of the December 31st deadline, the LIBOR transition remains dynamic, and you should seek qualified counsel on the latest conventional wisdom before making business decisions. Please note that this session is off the record. Comments, statements, and materials are for the express use of SBIA and are not to be published or recorded without approval by SBIA and today's sponsor, RSM US. The SBIA partners with top-level sponsors who provide valuable services, thought leadership, and educational resources for our members. And today's webinar is possible due to the ongoing support of RSM. A member of Global Accounting Network RSM International, RSM US is an audit, tax, and consulting firm focused on the middle market with more than 12,000 employees across the US and Canada. RSM recognizes that their clients are the engine of economic growth and diligently works to serve their evolving needs in today's ever-changing business environment. From RSM, we welcome Bill Andrioni, a Senior Director in Technical Accounting Consulting. Bill serves clients in the Philadelphia region and nationally, utilizing over 15 years of experience to help clients manage complex accounting and reporting responsibilities, analyze accounting transactions, develop accounting policy, and implement emerging guidance and service solutions. Joining Bill, we welcome Michael Gaso, a Senior Director in RSM's Accounting Standards Group. A 30-year accounting professional, Michael is a subject matter expert on financial instruments, advises audit teams, co-authors RSM publications, creates accounting guidance, and edits audit manuals. It's also a pleasure to welcome Stacia Copeland, Chief Risk Officer at NXT Capital. Stacia coordinates the firm's risk management activities, including loan review, operational risk management, corporate governance, and the company's risk rating models and applications. She is a member of the credit committee and manages the information technology, data governance, and loan servicing teams. Finally, we are pleased to have Michael Kogler of Market Alpha Advisors joining us. A co-founder and managing principal of the firm, Michael has over 3 decades of experience in financial services, an extensive background in a range of asset classes, and a deep knowledge of the technology and market structure of all fixed income, currency, and commodity markets. We appreciate all of you being here today. And Bill, it is now my pleasure to turn the virtual podium over to you to get us started.
Great. Thanks. And again, welcome everyone to the panel here. I think we have a great conversation ready to go for you. So, and just to echo the point earlier, we do truly want this to be dynamic. We welcome your questions and conversation here throughout the dialogue. So we will do our best to sort of navigate those questions and get them integrated in real time. So please, definitely fire at will with your questions, and we're hoping to have a bit of an open dialogue here today. So, I think as many of you in the audience are probably already aware of at this point, the sun is setting on LIBOR, right? There's no question about that. It is going away here. So with the cessation of US LIBOR extended to June 30, 2023, I want to be clear that while June 2023 is a date that you see out there often, the reality of it is there'll be no new LIBOR as of next year. So a lot of what we're going to talk about today is not so much what happens as the sun sets in 2023, but more specifically, what about the new deals? What's the future state here starting next year? I think if you look at a lot of the market statistics that are out there, there's somewhere around, 220 trillion dollars of U.S. LIBOR exposure across contracts, loans, derivatives, et cetera. Now, of that 220 trillion, about 60 or 70% of it will sunset as of 2023. So what does that mean? It still means that there's still a substantial amount that will outpace that 2023 environment, right? So there's contracts today that are going to outlive that 2023. And then there's the contracts of tomorrow, the new contracts that you're doing next week, that you're doing 1/1 of next year. How are you going to start using SOFR? So with that in mind, there's a number of fundamental challenges that companies are navigating, both during the implementation, as I mentioned, post-implementation of LIBOR. As I suspect many of you know, earlier this year, the ARC did announce their SOFR First initiative. They endorsed term SOFR for use in cash instruments and certain derivative transactions. Now, again, herein lies one of the fundamental challenges that we want to tackle on this panel today. SOFR could not be more different than LIBOR. SOFR, which is essentially a risk-free rate, behaves very, very differently in the market than a credit-sensitive rate such as LIBOR. Further, most of the liquidity in SOFR is in the overnight rate, not term SOFR. So, in other words, if you think about it, term SOFR is more forward-looking, reflects the market's expectations of what will happen at interest rates, where overnight SOFR is more rear-view mirror. It reflects what actually did happen. So, even if you're applying that overnight rate to instruments, it requires complex calculations that create significant operational challenges for the industry. So again, the fundamental point here is that, yes, there's been a rate change or there's been an index change, but those rates behave very, very differently, especially in times of financial distress. If you think about what we've all been through here in this past year with COVID and potentially what could happen in the future state, these two rates are going to certainly behave very differently. So as companies are navigating these implementations, a large part of the implementation plan is really thinking through the future state. How will contracts be designed? How are we going to execute deals? The types of hard or open fallback language that you have in your contracts. How will this rate change impact the deal process, the valuations? A lot of things that the panelists are going to sort of hit on here today. Now, as we get started, we also want to offer some perspective on where market participants are today in terms of their implementations. Again, as with many statistics, these are sort of broad, and I know there's a lot of nuances to them. But interestingly, what we found based on a lot of recent polls within the last few weeks even, there's a number of institutions that are still planning to continue to make deals with LIBOR all the way through year end. So one of the questions is, okay, you have to switch as of 1/1 next year, but in many cases in practice, people are switching today. But we're finding that not as many people are switching today, only a few of those institutions are actually doing that. Now, of equal importance, when asked what type of fallback provisions, again, the hard versus the open-ended, that are in place, approximately 30-40% still have not made a decision as of today. And many of them still have not fully assessed the operational or technology system implications. So I think with Stacia joining us here today from NXT, it's going to be really interesting to hear sort of her perspective on during the implementation project, the things that go well beyond just switching rates. There's operational, there's technology, there's system implications that you have to think through. Again, we're only 2 or 3 months away from year end here. It's going to go by quick. So with that, there's a lot to unpack here today. I'm sure we could talk about this for hours, but we want to get right into it. So I'm going to get right into the first question here with Michael Kogler of Market Alpha, who is actually RSM has partnered with to help companies really navigate a lot of these changes. So Mike, I'm going to sort of point the first question to you in terms of, what will you do, or how will the new 2022 deals that cannot be priced using LIBOR, how's that going to work? How's that going to, what are the implications there?
Sure. Thanks, Bill. And thanks to the SBIA for inviting me to this panel, and certainly, RSM as well. Thank you very much. It's a pleasure to be here. So as Bill mentioned, IBORs in most jurisdictions around the world are going away at the end of this year. US dollar LIBOR for legacy contracts, the deadline has been extended to the end of June 2023. So you have an extra 18 months to deal with legacy positions. However, the regulators have made it very, very clear that for new instruments, for new issuance, for any new loans originated, any new debt issued, any new hedge transactions, unless it's meant to hedge a specific instrument that you already have on your balance sheet, you cannot use US dollar LIBOR after the end of this year. So we have basically only 2 months left within which you can choose an alternative benchmark index. And the regulators have been pushing SOFR very hard. That's their replacement benchmark of choice. And SOFR is an index that, as Bill mentioned, could not be more different than LIBOR. As Bill said, the overnight SOFR rate has no term structure and it has no credit sensitivity. It's based on collateralized US Treasury repo transactions, which are backed by the full faith and credit of the US government. It has no credit sensitivity. LIBOR, on the other hand, has a term structure, 1 month, 3 months, 6 months, 12 months. And it is an unsecured rate that is a theoretical benchmark where banks lend to one another. So it has that overall credit sensitivity that SOFR does not. So that presents a whole host of challenges, as I'm sure everyone in the audience knows, but we're going to try to drill down a little bit deeper on what that means. So Bill, I don't know if you can go to the next slide. Yeah, this slide highlights very clearly what the differences are between LIBOR and other credit sensitive rates and then SOFR. Okay, so during normal times, this is a historical 5-year chart of the different rates. So overnight compounded SOFR, 30-day Ameribor, 1 month BSBY, and 1 month LIBOR. So during normal times, the rates track each other fairly closely. But whenever there is a credit event in the market, as you can see from this chart, happened in the beginning of March 2020 when we had the onset of COVID, we had a massive flight to quality and SOFR went to almost zero. It went to 1 basis point and the other credit sensitive rates gapped out, 100, 120, 140 basis points. If we go to the next slide, Bill, yeah, so this is sort of that same slide, but that one period of time blown up a little bit so you can see the differences. And here you can see what the potential problem is with SOFR, the lack of credit sensitivity with SOFR. If you're a bank or some other middle market corporate or lower rated tranche of a securitized product deal, your costs, your borrowing costs are nowhere near SOFR. Okay, they're much more closely correlated to our credit sensitive rate. So for instance, a mid-market bank, when they're managing their balance sheet, they don't fund at SOFR. They fund at something closer to LIBOR plus a spread. And in times like this, their funding costs are going to go up. So these kinds of considerations need to be made when you're implementing a rate like SOFR. Okay, so that's basically the gist of what I wanted to talk about right now. So Bill, you want to move on to the next slide?
Sure, thanks, Mike. So Stacia, I think we're going to sort of turn over to you to get some perspective, and clearly from what Mike has covered there, and certainly what we covered during the opening marks there, there's significant challenges and issues here, right? For financial institutions, for asset managers, what they need to consider when preparing for this transition. Especially as it relates to this difference that we keep echoing, right? This LIBOR versus SOFR credit difference, credit sensitive difference. So with that in mind, it'd be great for us to hear sort of how your firm has prepared during this transition, things that you went through, and certainly things that you're thinking about in terms of future state.
And Stacia, you're on mute.
Apologies. After 18 months on video or chats and Zoom, I should have remembered to turn that back off. Apologies for that.
No
Bill, do you want me to start with kind of how we are looking at 2022, or kind of the background of how we got ready for the transition?
Yeah, maybe if we start with the latter, just the background of kind of the fundamentals that you went through to get ready for that transition, and then how you're sort of moving into that future state plan.
Yeah, sure. So as you noted, this has all kinds of impacts across our organization. So the biggest thing for us, I think, is we started looking at this a couple of years ago and pulling together our team is to make sure we kind of got educated and we're keeping up to date on what was going on, what was the communication from the ARC, kind of what was the industry thinking. So we really tried to stay on top of where things were moving so we could be prepared. We also needed to pull in people across our organizational, so across our organization, so across functions. So we pulled together a working group, which I chaired, and we had representatives from legal, compliance, treasury, finance and accounting, from our lines of business, from my risk team, technology, and our loan servicing team, because it really impacts, everything throughout the flow through our organization. And we needed them to understand the impact to their specific areas of responsibility. So we pulled together this team, like I said, tried to keep ourselves educated. We had to look at not just the loans that we issue, but our funding costs as well. So we had to look at, we have credit facilities, so we had to talk with our banks and think about how they were going to approach it, which also can have an impact on what we were going to do as we were lending to our clients. So we pulled together a project plan that walked through everything from, the legal documents that we had to open up and take a look at. And again, that's on the asset and the liability side. It was easier for us on the liability side. On the asset, we had to go through our entire portfolio. And we've really been keeping that up to date over the last couple of years, trying to understand where we have to amend a document, where we were in a position that we had hardwired fallback language, which we just started to see probably over the last 6 months. And just to make sure we understood, what we had and what we were dealing with in terms of, as this deadline approached. But then we have a bunch of systems and tools that we use, and some that we rely on. Our loan servicing system, we have an outside vendor. So we hadn't done an update to that system for several years. So one of the first things, which is, for us, we needed to really start early, is that we had to work with the vendor and get queued up to do the update. They were going to roll out the capabilities on our loan servicing system first to the most current version of the platform. So just upgrading our loan servicing system was the actual sort of execution of that, between all the testing and the rollout, took about 6 months. And that was just to get us ready so we could accept the enhancements that were being made to the system. And then we had to actually test those once we completed the upgrade. So we really needed that, kind of lead time. And frankly, our vendor was pretty backed up because everybody was moving in the same direction, right? Everybody wanted to be ready for the changes that were being put through. We are now, and then we had identified, tools that we use internally. So everything from underwriting models, tools that our accounting team uses, tools we have, automated tools that our closing team uses, and those sort of things, to make sure that we understood the impact there. And so then that became kind of a second priority in terms of technology. And then a huge impact for us is how we were going to report on this. We have required reporting to our investors. We're an asset manager. We have a lot of funds and SMAs that we manage. So how we were going to report pricing is a key piece of information that we provide to them, sometimes on a daily basis. So now that we're going to be operating in a multi-rate environment, there's some challenges around, pretty much all of our portfolio was LIBOR, a term rate. Occasionally there's some prime, but how are we going to, report that to our investors. So I think getting that project plan in place, we had a timeline around the things that we were going to do. It was a little tricky because sometimes we were relying on vendors, and then really prioritizing, like I said, the system upgrade was the most time consuming. But that was really kind of how we organized ourselves, and that, you know, kind of high level, our approach to making sure that we were ready.
It sounded, interestingly, it sounded like some of those polls or statistics that we referenced earlier in the conversation, one of them specifically was around third-party systems and providers. So where there's this reliance on folks that are external to the firm, especially when you get into technology and systems. So, and it seemed to imply that in a lot of cases, those conversations are still ongoing, or that, you know, those third-party providers may not necessarily be fully baked themselves in terms of being ready for this transition. So based on your experience with some of those third-party providers, the technology piece, the component, it sounds like that's definitely something people have to get in front of before year end. Any other suggestions or just lessons learned around that, or things that people should really try to get in front of over these next few months?
Yeah, well, I mean, I think, you know, the big thing for us was the announcement that there was term SOFR was going to be available, which we really, you know, we started seeing indications of that probably in the spring, but didn't have certainty around that. That obviously, because it's a term rate, it operates, while there's differences between the rates operationally, it's much easier to implement within our existing framework. So I think that, you know, helped us a lot. And, you know, we were over a year ago trying to figure out how we would handle compounded SOFR. And now it looks like if we go to a daily rate, it'll be a daily simple SOFR. So I think that was, you know, just staying on top of what the requirements might be. And there's still a lot of uncertainty with the spread adjustment and how things are going to be handled. But I think those were, you know, kind of the key things that we needed to think about. And I mean, we're a senior lender in the private debt space. I probably should have opened with that. So, you know, we aren't offering as the multitude of products that some other institutions are. So I think that made it a little easier for us as well.
Excellent, excellent. And maybe actually before we dive into more of the future state and sort of how you're going about the new deals, the 2022 onward look, maybe even taking a step back and having you and Mike really kind of help us more broadly think through just, you know, what will you do with your 2022 deals, right? So now that they cannot be priced using LIBOR, how's this going to work? So Mike, maybe I'll sort of turn it back to you before we go forward with Stacia on the future state, and you can help us sort of navigate that question.
Sure, absolutely. Want to jump to the next slide? So, you know, as I said before, and as Bill said before, SOFR could not be more different than LIBOR, right? And so this slide just shows a range of instruments out there that are typically indexed to LIBOR. And as you can see, and I think Bill mentioned the number, 220 trillion in notional of instruments that are tied to US dollar LIBOR. That is a huge number, okay? When you, just to put that in perspective, that's 20 times the GDP of the United States. So this is a massive undertaking, particularly in the United States. And as you can see from this chart, there are a large number of instruments that are tied to LIBOR. And you can think of LIBOR almost as water seeping through every little nook and cranny of an organization, right? It touches everything from, you know, your liabilities, your assets, transfer pricing, you know, credit calculations throughout your institution, you know, capital costs, you name it, right? It's ubiquitous and everywhere throughout an organization, and it's embedded in all these types of instruments. So the question is SOFR the best index to use in all these types of instruments? And I would say that a lot of our clients are having some concerns about using SOFR in everything. There are certain types of instruments that just don't work well in SOFR. Okay, so for instance, long dated floating rate instruments, further down the capital structure, lower rated. You know, you're locked when you do a deal, a 10-year deal, a 15-year deal, a 20-year deal, and you're locking in that credit spread today. As I showed from that previous chart, when you have credit events like what happened with the onset of COVID, you know, the deal is not priced for that. If it's based on a credit sensitive rate, you have some protection as an investor in those types of situations, but with SOFR you don't, okay? So if we go to the next slide, this is kind of one of the things that the industry is really trying to grapple with. And like, let's take the syndicated loans as an example. So right now, syndicated loan is priced as a two-stage. It basically uses two-stage pricing. Okay, so you take the benchmark, you take the borrowing spread or the applicable margin, and that's the interest rate that you pay at the end of the period. Okay, everyone knows where to price these deals if they're benchmarked to LIBOR. But now that you're putting SOFR and the bulk of the market, as Stacia mentioned, there's a whole host of issues trying to implement compounded SOFR, daily simple SOFR. So the fact that the ARC has endorsed term SOFR is a very good thing for the market, because from an operational perspective, it's much easier to handle. So so the bulk of the loan market is going to go to term SOFR in terms of the benchmark that they're going to use in syndicated loans. But they still have the problem of where should these deals be priced? Okay, so they know where they should be priced on LIBOR, but with SOFR, the market is having a difficult time in terms of assessing where that credit spread adjustment should be between LIBOR and SOFR, which is a risk-free rate. So the market is starting to move to three-stage pricing, where you're going to take the term SOFR rate, the applicable margin, and some credit spread adjustment that they're going to need to put into deals when they price them. And again, this is a static spread. So when you price the deal, it's set today, that credit spread adjustment, and it stays there for the life of the deal. So where does the problem come in? The problem comes in because back in March, when the IBA finished their consultation as to when they're going to discontinue publishing LIBOR, that was back on March 5th, it set in motion a whole bunch of things. One of the things it set in motion was the calculation by ISDA for that historical 5-year spread between SOFR and LIBOR, which is going to be the conversion spread that the ARC is going to recommend. Everything that gets converted from LIBOR to SOFR is going to get converted at that 5-year historical average spread that ISDA calculated back in March. So let me just make that clear. In June 2023, okay, when your LIBOR deal converts to SOFR, if it's, let's say it's an interest rate swap, the LIBOR rate's going to be taken out, and then SOFR plus this ISDA spread is going to be put in there as a replacement. Okay, and if you look back historically over the last 5 years, the spread between SOFR and LIBOR was much wider than it is today. And so this column here in the chart, which shows the ISDA spread, it's 11.5 basis points for 1-month LIBOR, 26 basis points for 3-month LIBOR, almost 43 for 6-month LIBOR, and 71.5 for 12-month LIBOR. But when you look at where the market is today, where the market is trading today, the spreads are much tighter. So 1-month LIBOR, it's roughly 4 basis points, 3-month LIBOR, 7.5, 6-month LIBOR 12, and 12-month LIBOR around 27. Okay, so that's a huge difference, a humongous difference. So just look at 12-month LIBOR. It's 45 basis points difference. Okay, so anyone that is taking out a new loan today, if your lender comes to you and says, okay, I know you're paying LIBOR plus 250, but we're going to replace that with SOFR plus 276. and now your interest rate, your all-in interest rate cost is going up. Well, wait a minute. A lot of borrowers are pushing back on that, and they're saying that doesn't work for me. I'm moving to this new SOFR world. I don't want to pay more than what I'm paying now. Why should I pay more? Okay, and so they're pushing back and trying to negotiate a rate that's comparable to where the current market is trading. And then the other thing that borrowers are pushing back on is making the adjustment directly on the applicable margin, which is why now it's moving to this 3-stage pricing methodology, because this way they can isolate that credit spread adjustment that's being made by the lender or the lending group and negotiate on that, as opposed to negotiating on the all-in margin, which includes this credit spread adjustment. Okay, so essentially, the market still does not know where the right levels are for SOFR deals, and the market is still trying to figure out where new deals should be priced if they're indexed to SOFR. Does that sort of cover it, Bill?
Yeah, that's great. That's fantastic. And I guess in that context, Stacia, it'd be really interesting to kind of bring it back to you now in terms of what Mike just covered. So as we sort of migrate to that future state, how is a lot of this going to be impacting you guys, or what are some of the challenges that you're having to block and tackle here around these valuation considerations, the rate switch, the fact that the contract, the pricing, the valuation, all these different elements sort of converging all at once here. If you could share any insights or considerations that might be of value.
Yeah, so I mean, I think the topics that Mike raised, particularly around this credit spread adjustment, is really what has slowed the market down. I mean, we thought that we would have been seeing deals priced on SOFR by now because the regulators were pushing for people to adopt SOFR soon, and a lot of the banks have said that they were going to, after 9/30, implement SOFR. It has not filtered down yet to the middle market. We are just seeing our first deal that's an existing deal with an amendment that there's a proposal to roll to SOFR. But, I think the points that Mike made about just people aren't really sure. I mean, there was some talk about, do you, when you originate a new loan, do you amortize in the impact of the credit spread adjustment? Do you build it into the index, or do you, have it as a separate? And I think people are moving more towards keeping that credit spread adjustment as a separate field. But, we typically have multiple lenders in the deals that we do. We're not a bank, so we're not regulated as a bank. We need to be flexible, I guess, enough. We need to understand what the banks are going to do. I mean, our approach has been that we're not going to lead, but we want to be able to be a quick follower. So we really are. I have a working group that I meet with every couple of weeks, just so we can all stay on top of what we're hearing and seeing in the market. We have the benefit of having floors on most of our deals, and our floor is well above LIBOR and SOFR. So that gives us a little bit more time to kind of figure it out because the floor is in place right now. So I think, we're still so there's not as much of an impact, right? Because you're using the floor in your pricing. So I don't know if I answered your question, but those are just some of the things that we're thinking about. And again, I talk to our originators all the time, and people aren't asking for SOFR yet. I think it's going to be kind of driven by there's a negotiation, right? And everything that you do, you're always negotiating with your borrowers, but it seems like it's going to be driven by kind of the banks. And that's why I'm staying in communication with them as well as some of my peers to try and figure out, how we're going to approach this.
Yeah, well, one of the things, Stacia, you mentioned sort of taking guidance from the big banks, right? Well, a lot of clients we deal with, and a lot of clients we work with in conjunction with our collaboration with RSM are smaller institutions, maybe middle market banks, middle market corporates, etc. And they're not getting the guidance from the big banks. The big banks don't want to really advise them to do anything because, one, they're not sure themselves which direction the market is going to go in or where these things should be priced. That's number one. And number two, quite honestly, they don't want to give someone advice and have it go wrong, and then they wind up in a lawsuit. So
Yeah.
So the banks, so one of the complaints we've heard from a lot of customers is they're not getting the guidance from the banks on what they should be doing, right? They're not being told by the big money center banks, this is what you should be doing, this is what we recommend. They're not making any recommendations. They don't want to be in that position. And that's the other thing that has really slowed this transition down.
Yeah, I want to just clarify. I maybe didn't mean so much that we're taking guidance. I'm not sure if that's the word I use, but we are looking to see what they're doing. Obviously, when we have banks that are co-lenders with us, I mean, if we want to offer pricing that's also going to work, that they're going to be able to, participate in a transaction, and we want to be able to participate in their transactions because there's multiple lenders. So I don't know if it's so much guidance, but we want to understand, what they're doing. So some of the banks that are lenders in the middle market, like we are, that's who I'm trying to talk to. And again, talking with some of my peers that are non-banks also, and just hear and see what people are doing in the market. Because you obviously want to have as many options as possible when you're originating a transaction and you've got other lenders, you're counting on other lenders coming into that facility.
Yeah, well, I talk to also a lot of CLO managers, securitized product firms that are issuing a lot of securitized product deals, and they tell me, look, we're a taker, right? We're going to do what our banks recommend, okay? And so they've not gotten a tremendous amount of, and maybe guidance is the wrong word, but they've not gotten a tremendous amount of communication directly from the banks, and the communication, quite honestly, has been a little contradictory. One of the large money center banks, up until a couple of months ago, was really pushing BSBY, right? One of the credit sensitive rates, and they had webinars and telling everyone on the webcast that they recommend using BSBY because it's closer to LIBOR and it solves some of the issues with LIBOR, and it's easier to use. We can price a deal more effectively at a lower cost for the borrower if it's against the credit sensitive rate. And then the regulators came out and tried to destroy it and created all this confusion. So that's the other, I didn't mention it before, but that's one of the other reasons why this process has moved so slowly, is that the guidance from the ARC and from the regulators has changed. Like you said, they didn't endorse term SOFR until July of this year. And in fact, in the beginning of the year, they said that they might not endorse term SOFR and just use daily compounded SOFR, get on with it. Well, from everything we've talked about so far on this panel, that just doesn't work from an operational perspective for a large portion of the market. So anyway, go ahead.
Excellent. And Stacia, there's one other thing I want to sort of unpack just a little bit more based on your response there. The topic of investor reporting, or just considerations around, call it external reporting, starting in 22 onward. Any considerations or thoughts there in terms of, maybe there was, whether it's communications or it's just the manner in which it's tracked, et cetera. Anything that's worth articulating or covering in terms of investor reporting, or I'll even call it external reporting?
Yeah, well, I mean, I think that our investors, the funds and SMAs that we manage, are really, they're very knowledgeable, and they've been coming to us with questions and asking us the same things that we're talking about here, like, how are you preparing? What is your approach? how are you going to share that information? How is that going to, is it going to have an impact to our yield? So we've been really engaged with them over the course of the last year as they saw this on the horizon, and sharing information. And like you said, it's been a moving target, right? For a while we thought we were going to go to BSBY, we thought we were going to, or going back a compounded rate, then a daily simple rate, and then it was BSBY, and then it was, well, maybe there's going to be term SOFR. So we really just try and have communication with them. And almost everyone we meet with at least quarterly, and we often get inquiries, more frequently. So we're just trying to have an open dialogue with them about where I could talk to someone today, and by tomorrow, whatever I told them today may change. But just having a open dialogue with them and giving them confidence that we're going to be prepared through our systems and our tools and our legal documents will be updated as needed. So.
Got it. Excellent. Fantastic. And Mike Hogler, I guess, just to bring it back to you again, because I think you hit on some really important elements there as well. So given that your firm works with a number of asset managers and just, institutions in general around LIBOR, the transition, the future state considerations, et cetera, I guess if you could share with us, what are some of the things, in addition to what you've already articulated here, but what are some additional things that you're hearing from your clients, hearing from your, portfolio of companies that you work with, just other things that maybe we should be considering or thinking through?
Well, I think the main focus for a lot of our clients, and we have a wide range of clients. We have some middle market banking institutions. We have some big asset managers that we have as clients. And I think the main focus for most of this transition period has been just getting a handle on their risk and what they need to do. So looking at all the various deals that they have on their balance sheet, figuring out what the fallback language is in those deals, understanding what the economic impact is of those deals, isolating those deals that they feel are problematic, and coming up with a remediation strategy. The other thing is a communication strategy. All of our clients, whether they're a bank or an asset manager, they have clients of their own that are asking them questions. Just like Stacia, I'm sure, has clients that they're dealing with that are asking questions, right? Investors, whatever it might be. They're asking information of all their counterparties. Where is my risk? What are you doing to address this, et cetera, et cetera. So we spend a lot of time dealing with those issues, responding to our customers' clients' requests, okay? So I think that now we've moved into a different phase. We've moved into a phase where in 2 months, I can no longer buy, if I'm an investor, I can no longer buy a newly issued LIBOR deal. I have to buy now a SOFR deal or a deal that's indexed to something else. I'm moving into this world. I really need to get a handle on what the differences are in these types of deals, moving from a credit sensitive rate to a completely risk-free rate. Yeah, and you actually had a chart just up there I wanted to show you too. That graph, I think you skipped over it. Yeah, this graph. So I didn't talk to this before, but I'll just show this real quick. So this is a chart of overnight SOFR. And since March of this year, it's pretty much only traded at 2 levels, 1 basis point and 5 basis points. Last week, it actually blipped down to 3 basis points for a couple of days, and now it's back up to 5 basis points. But I guess this highlights another just consideration, right? With SOFR, it's only traded at 2 levels for the better part of a year. Okay, so it's kind of hard to argue that this is a market-driven rate, in my opinion.
Yeah. Visualization says it all.
Yep.
Excellent. Well, I'm just being cognizant of the time here, and then there's actually a few other topics that we do want to make sure we cover off on here for the audience. So Mike Aso, would love to sort of switch this over to look at this more through an accounting or technical accounting lens, because certainly a lot of what we've talked about in terms of operations, technology, the new deals, just how you navigate all those different challenges, certainly encompassing that is also accounting, right? Financial reporting, accounting, disclosures, how you're reporting some of this to external stakeholders and investors. So maybe you could kind of help offer some color or context in terms of what are the technical accounting considerations, what are the financial reporting considerations that people need to be thinking through?
And Mike, you're on mute. Mike Gaso.
Okay, thank you there. I like Mike Kogler's analogy earlier about LIBOR being like water trickling through an organization that touches just about everything. And of course, touches technical accounting. And you know, sometimes it's unfortunate that technical accounting comes in on the back end, and sometimes there's some benefit to thinking about it a little bit more upfront. And specifically in this case, there's a couple of instances. You know, in U.S. GAAP, when a debt instrument is amended, and by debt instrument I mean not only debt that you issue, but maybe debt that you invest in, or also talking about a simple receivable or a loan. When those debt instruments are amended, GAAP requires you to perform an analysis to determine whether that instrument should be, whether that amendment should be accounted for as a modification, which is a lot less onerous, or an extinguishment. And in the case if all you're doing is changing the rate from LIBOR to another rate, I think it's pretty obvious the way the analysis would work that you would come out on the side of a debt modification. However, you are obliged to actually do the analysis, and that just seems like a lot of work to do to apply with GAAP for a an answer of steady as she goes. And so what the FASB has done is the FASB has come up with a list of practical expedients that you can take advantage of. And if you make the election, you can account for these amendments all as debt modifications, which reduces the burden of doing a lot of analysis. The other thing is when it comes to, say, hedge accounting, you know, if you have an interest rate swap and you're using that swap to hedge debt that you issued, well, now we have two instruments, right? And if both of those instruments are referenced to LIBOR, as they would be in a typical swap debt relationship, you know, those instruments, those separate instruments, may not migrate to the new rate at the same point in time. And so there may be a number of days or months or however long a period of time where there's a mismatch between the new reference rate on one of those instruments and the old reference rate on the other. And again, there's a practical expedient that you can elect that the FASB has given us, so that, you know, you can go along with your accounting and ignore for a brief period of time that mismatch. But this has to be elected up front and has to be properly documented. And you know, and the other thing to keep in mind is that these practical expedients, and there's quite a long list of them, they're in ASU 2020-04. These practical expedients, the sun sets on them. In other words, the FASB didn't want this out there forever, and when they created this accounting standards update, they were thinking of, you know, 12/31/22 as being a date that the sun would set on these expedients. Well, now we know that some of LIBOR tenors will continue to be published until June 30th, 2023. And so just from some conversations that I have had informally with FASB staff, this is on the FASB's radar. They're aware of it. And so I would say, you know, stay tuned, because that sunset date would likely get extended or may get extended. I don't want to speak for the FASB. The other thing to think about is in terms of actually applying the hedge accounting. Now, I know for some people in the audience, they may not use hedge accounting, but some may. And there's basically, two models that are used when it comes to hedging financial instruments: a fair value hedge and a cash flow hedge. And what people may not be focused on is that for fair value hedges, and remember, hedge accounting gives us some preferential accounting treatment, right? So for fair value hedges, you have to be hedging one of the qualifying benchmark rates as per the FASB guidance. And currently there's 6 of those rates, and overnight SOFR is one of them, but term SOFR currently is not. So again, from informal conversations, this is something that may be changing in the future, but as of now, you cannot get a fair value hedge if you want to hedge term SOFR.
Hey, Mike.
Yes.
Mike, that's a very interesting point worth emphasizing, right? Is that, the ARC wants people, wants people to move to daily compounded SOFR in their hedges. There's only certain instances where you're even supposed to use term SOFR. If you have a specific instrument that you're hedging with term SOFR directly, then that's blessed by the ARC. But if you're just putting on a macro hedge or issuing fixed and swapping it to floating, I think that their preference is daily compounded SOFR. And certainly the entire interdealer swap market is moving to daily compounded SOFR. Okay.
Yep. Yeah. No. Good points. And for cash flow hedges, the rules are a little bit different. You can hedge any contractually specified rate, and so if you had a loan that was linked to term SOFR, you can designate that as your hedged risk. That's fine, but you would need a term SOFR derivative to properly hedge that, and now we have that go ahead that derivatives can be referenced to term SOFR as well. So that's some good news there. But just some couple of things to think about on the accounting forefront.
Yeah. No, that's great, Mike. Thanks for that context. I mean, there's always these unintended consequences, right, from a lot of these switches and changes, and I feel like accounting sometimes gets a sort of an afterthought, and it's going into year-end audits, going into year-end financial reporting. I mean, there's a lot of things you have to think through. And as you mentioned, the accounting guidance, there are these package of expedients available for those that can apply, but you have to elect them. It's not just given. You have to disclose that you've elected these, make a policy. So again, there's a lot of exercises as you're going through the implementation, as you're getting ready to go into 2022. Just make sure you're checking all these boxes, and accounting is one of them. Accounting is definitely a very, very important one. So thanks again, Mike, for that context. That was really helpful.
Sure.
Okay. So let me bring it back. Stacia and Mike Kogler, maybe we'll bring it back to you guys, because again, I think there's a lot of interesting things that have sort of evolved over this conversation. But as you think about more of the small or medium-sized, financial or lending institutions, what recommendations do you have in terms of what we offer to clients in terms of a benchmark rate? Like, what would you suggest or recommend?
Yeah, I can take the first crack
Sure.
at that. So what we have heard directly from institutions that we're talking to, and what we certainly recommend is be prepared to offer instruments on more than one benchmark index, okay? Because you don't know how this is going to evolve. It's, as Stacia mentioned, it changes. The rules change all the time, right? So we don't know where this is going to end up. We know that the bulk of the market is going to go to term SOFR, but we're not sure if any of these credit sensitive rates may pop up. And certainly you want to be in a competitive position as an institution to offer customers choice, right? So if, for instance, deals start getting done on Ameribor or a Bisbee, you want to be in a position where you're not scrambling around to offer that, where you have the ability to offer products based on those indices. So most customers we're talking to are sort of gearing up for 3 indices: Term SOFR, Ameribor, and Bisbee, especially the smaller banking institutions. And sort of they're gearing up to offer all of those options. And some other institutions are offering daily compounded SOFR and daily simple SOFR as well, depending on the sophistication of the institution. But I certainly think those 3, Term SOFR, Ameribor, and Bisbee, if I were the treasurer or CFO of a bank, I would set myself up to offer all 3 of those indices and products. I don't know, does that make sense? Stacey?
Yeah, I mean, I couldn't agree more, Mike. That's exactly what I was going to say, that we just have to be prepared, I think, to live in a multi-rate option environment, right? I mean, it's not, to your point, not just the term rate options, but, you know, daily rates, compounded rate, it just gets a lot more operationally complex. And even on the pricing side, I think there is going to be, you know, more education for people to kind of figure out how all these rates work. But I think it's going to get more complex. I mean, the world we've lived in with LIBOR, you know, we have prime options on our loans, but they're hardly ever used.
Right.
And so you're living kind of in this sort of simple and clean world where everything was consistent, everybody's using LIBOR is going away. So
yeah, and
I think it's like everyone, I guess my point being that not every product that we offer is going to be a term SOFR. You know, we're fully expecting that over time there's going to be different flavors.
Yeah. And look, I think SOFR, especially term SOFR, is a rate that makes sense for a wide range of use cases, wide range of instruments, right? But not every single one. Okay. And I think that you just need to be prepared for that.
Excellent. Well, there's a few other questions, but I do want to just encourage, as we're coming to the top of the hour, if there's any questions from the broader audience here, anything that we can, you know, respond to or address, just want to give everyone a moment here to ask those. And if you're not able to see it or locate it, there should be a chat box or Q&A type box. But let us know if there's any questions. So maybe as folks are thinking through if there's any additional questions, one of the other items, Mike, in terms of just kind of as people are thinking through just the volumes of detail that are out there, the regulatory information, the guidance, et cetera. You had mentioned, I think, at some point that there was some recent guidance that was, or interagency recent guidance that was issued in the past week or two. Anything that the audience should know about that, or any good, you know, just nuggets or pieces of information that might be worth noting here at the top?
Yeah, so there was just some additional interagency guidance that was issued last week by the various regulators, the OCC and others, which basically clarified a number of things related to the LIBOR transition. One of the bigger takeaways from my perspective is they made it crystal clear that you should not be doing any new deals tied to LIBOR after the end of the year. And there was, depending on who you talk to, some uncertainty as to that and some confusion as to whether or not, because they did make this extension to June 2023, and they have made it, you know, quite honestly, they have made it fairly clear that it only applied to legacy deals, but there was still some uncertainty out there in the market. And you know, we've heard stories and seen surveys and things that have led us to believe that there's still a large percentage of the market out there that plans to continue to do LIBOR deals after the end of the year. And if you're in that position where you haven't done anything yet and you're still planning to do LIBOR deals after the end of the year, well, the next time that you sit down with your regulator, it's going to be an uncomfortable conversation. And so, you know, there's ways that you can potentially address that even now at this late hour. But that guidance was, that one of my takeaways from that guidance was making that extremely clear. I don't know, Stacia, do you have any thoughts on that as well?
Yeah, no, I think that's exactly right. And I think you captured it very well, Mike, that they made it very crystal clear.
Fantastic, fantastic. Well, with great timing here, we are at the top of the hour. Again, for maybe some background or context, so the materials that we've gone through here today, and certainly the recording itself is going to be available, and our contact information. So as you step away from hearing the insights from today, if there's additional thoughts, considerations, questions you have, by all means, the panelists and myself, we offer ourselves up as available to you. Always happy to have that dialogue. Again, just to emphasize or hammer home some of the important points here, we're switching, right? We're switching here as of year end. You really should be thinking through how these new deals are going to be executed. And it's not as simple as flipping the switch from LIBOR to SOFR. There's, the behavioral characteristics of the rate. There's the fact that there's valuation considerations. You heard Stacia mention a lot of important things around the operational components, the technology components for the implementation. And Mike really hit a lot of the key points around accounting. And then Mike Kogler really hit a lot of the key points on everything else. So certainly a lot to consider here. Again, welcome additional comments, subsequent to this conversation, and I hope this was of value to everybody, and have a good rest of your day.
Great. Bill, Michael, Stacia, and Michael, a sincere thank you for sharing your considerable expertise on a complex and evolving topic. The pending LIBOR transition remains in flux, and we highly recommend that you stay in touch with these experts. Their contact information is included in the presentation deck. A replay of today's webinar will be sent to SBIA members in the daily debrief and will be available on our website at sbia.org. Please watch for details about future webinars and membership emails, as well as on social media and the SBIA website. We encourage you to join one of our upcoming in-person networking events. On deck, we have a reception in Naples, Florida on November 11th, and a holiday event for women in private equity on December 2nd in Chicago. And kicking off the new year, registration is now open for our 2022 Northeast Private Equity Conference on January 27th and 28th in New York. Please visit the events tab on sbia.org for details and to register for these and other events. Finally, if you're not a member and would like to learn more about joining SBIA, please email membership@sbia.org, and my colleague Michelle Lamel will reach out to you. Thank you again for participating in our webinar, and we look forward to seeing you at an upcoming SBIA event.
Thank you.
Thanks, everyone.
Thank you.